Gary DeWaal here, and this is Bridging the Week for May 12th to 16th, and today is May 19th, 2014. Good morning. No sparks flew during the Senate Committee on Agriculture, Nutrition, and Forestry's hearing held last week to better understand low latency and other forms of automated trading in the derivatives market. However, while the focus at this event was on modern forms of electronic trading, the emphasis in simultaneous enforcement actions by the U.S. Commodity Futures Trading Commission and the UK Financial Conduct Authority, as well as a separate disciplinary action by multiple U.S. securities exchanges, was old-fashioned manipulation. We have a lot to cover, so let's get right to business. The U.S. Senate Agriculture Committee held a hearing last week on low latency and automated trading in futures markets. Despite the heightened attention this topic has received since the March 31st publication of Michael Lewis' Flash Boys, A Wall Street Revolt, the tone of the meeting was calm, and the discussion emphasized the differences between futures and equities market structure. Indeed, in her opening remarks, Chairwoman Debbie Stabenow conceded that some of the concerns about the equity market are not applicable to the futures markets. Throughout the hearing, one of her greatest concerns was whether the U.S. Commodity Futures Commission had adequate resources to oversee automated trading in markets. Quote, "For a 21st century market," end of quote, she said, quote, "we need a 21st century regulator," end of quote. 3 witnesses appeared before the committee for this hearing. Vince McGonigal, Director of the Division of Market Oversight of the CFTC, Terrence Duffy, Executive Chairman and President of the Chicago Mercantile Exchange, and Andrei Kirilenko, Professor of the Practice of Finance, MIT Sloan School of Management, and former Chief Economist at the CFTC. In his remarks, Mr. McGonigal surveyed the current state of regulation of exchange-traded derivatives markets in the U.S. He also discussed topics raised in the CFTC's recent concept release regarding automated trading. Mr. Duffy engaged in more advocacy during his testimony. First, he stated uncategorically, quote, "the U.S. financial markets are not rigged," end of quote. He went on to discuss some elements of the CME's market structure that he claimed helped maintain a quote-unquote level playing field for all customers. Mr. Duffy also spoke of the advantages of co-location that he claims promote equal access to the CME. Dr. Kirilenko was the most aggressively critical of low-latency traders. He spoke of this group being, quote, "dominated by a small number of fast and aggressive incumbents," end of quote, who achieved high and persistent returns. As a result, he made 4 specific recommendations, including that there be a broad definition of automated brokers and traders, potentially to introduce a registration regime, and automated markets that should utilize short-term trading pauses and reopening auctions. After their comments, members of the committee asked all 3 panelists questions. The speed at which market data is disseminated to the public was the most frequently discussed topic, with Mr. Duffy arguing that latency issues really do not exist at CME because, quote-unquote, all market data goes out at once. However, Dr. Kirilenko claimed that public concerns about latency are fully justified. Both Mr. Duffy and Mr. McGonigal indicated that the CFTC needed sufficient resources and automated technology to monitor automated markets. According to Mr. Duffy, quote, "I don't believe the CME has a credible business if we don't have a credible regulator. I want the CFTC to be the envy of the world," end of quote. Both the CFTC and the UK Financial Conduct Authority settled enforcement proceedings against interdealer brokers they claim participated in the attempted and actual manipulation of the official fixing of the London Interbank Offered Rate from at least September 2008 through August 2009. These brokers allegedly were enlisted by a senior trader initially at UBS Securities, Japan Co., and later at another bank to attempt to manipulate LIBOR by influencing the rates submitted by other panel banks involved in the rate's daily setting. The senior trader was endeavoring to improve his derivatives trading tied to the benchmark. The CFTC settled its action against RP Martin Holdings and Martin Brokers Limited, interdealer brokers, by their agreement to pay jointly and severally a civil monetary penalty of $1.2 million US. The firm also agreed to institute certain measures, including improved policies, controls, and documentation, to enhance the integrity and reliability of other benchmark interest rate related market information they disseminate. The FCA settled this disciplinary matter against Martin Brokers by the firm agreeing to pay a fine of 630,000 Great British pounds, which is slightly in excess of $1 million US. The Chicago Board Options Exchange and the Financial Industry Regulatory Authority, on behalf of 4 other exchanges, settled disciplinary actions with HAP Trading and its Chief Executive Officer, Harsh Padilla, along with Sagar Gupta and HAP Trader. These charges related to Mr. Gupta's purchase and sale of various securities from approximately May 2010 through July 2010 to improperly influence the prices of the securities and their corresponding options. Mr. Gupta then purchased or sold these options to benefit from the artificial price movements. During this time, Mr. Padilla was responsible to supervise HAP's trading, compliance, and offer supervision. CBOE and FINRA charged Mr. Gupta for his trading activities and HAP and Mr. Padilla for failure to supervise. A U.S. Securities and Exchange Commission registered broker-dealer was sanctioned almost $850,000 US for assisting an unnamed company to act as an introducing broker without itself being registered as a broker-dealer. Rafferty Capital Markets entered into agreement with an unnamed company in 2009 to provide it certain clearing and executing services in fixed income securities. Futures Commission merchants and broker-dealers must ensure that entities that introduce business to it for compensation are appropriately registered with the CFTC or SEC as appropriate, and members of the National Futures Association or FINRA, respectively. Introducing agents in the futures industry can be registered either as a Futures Commission merchant or introducing broker, or as a broker-dealer in the securities industry. And finally, the Securities and Exchange Commission issued an investor alert following an increase in the number of complaints it has received related to marijuana-related investments, as well as its suspension from trading a number of companies that claimed operations related to the marijuana industry. I know I could make some pithy comment on this advisory, such as reefer madness gone mad, but I won't. Well, that's it for this week's Bridging the Week. As always, there is more information on each article, and more articles on the article version of Bridging the Week. Check it out. Until next week, this is Gary DeWaal. Have a great week, and ciao!